Do you ever wonder if you're investing your money in the right order? The truth is, the order you invest in can sometimes matter more than the amount. Today, I'll show a simple, smart strategy that can help your money grow steadily over time. By the end of this video, you'll understand the steps you can take before investing in stocks, how to manage risk, and how to build a strong foundation. You'll learn the order that many financial experts use, explained in simple terms, so you can feel confident with your money. Investing isn't just about picking stocks or funds. It's about creating a smart plan, starting with the basics, and gradually moving to higher risk investments. When you follow the right sequence, you may reduce mistakes, avoid unnecessary losses, and give your money the best chance to grow. Let's break it down step by step. 1. Start with your emergency fund. Before investing, it's wise to build an emergency fund. This is cash set aside for unexpected expenses, like medical bills, car repairs, or temporary job loss. A common rule is to save 3-6 months of living expenses. For example, if your monthly expenses are $2,000, aim for $6,000, $12,000 in a safe, accessible account. Why this comes first? You avoid needing to sell investments during market dips. You have peace of mind knowing unexpected costs won't derail your finances. A simple way to start: set aside a small amount each month automatically. Use a high-yield savings account or money market fund, which is safe and easy to access. Do you already have an emergency fund, or is this your first step toward one? Comment below. I'd love to hear where people are starting. 2. Pay off high-interest debt. Before investing heavily, consider paying off high-interest debt, like credit cards. Why? The interest you pay often outweighs potential investment gains. Example: credit card debt at 20% interest. Even if your investments return 8% per year, you're losing more on the debt. Paying down debt first improves your cash flow, reduces stress, frees money to invest smarter later. A practical approach: list debts by interest rate. Focus on the highest rates first. Make minimum payments on the rest while accelerating the high interest ones. 3. Take advantage of employer retirement plans. Once your emergency fund is ready and high interest debt is under control, the next smart step is to prioritize employer retirement plans, such as a 401k in the US, or workplace pensions in other countries. These accounts can give your money a head start because they often come with benefits you can't get elsewhere. One major advantage is employer matching. Many companies will match a portion of your contributions, which is essentially free money added to your retirement account. For example, if your company matches up to 5% of your salary, contributing just 5% means your account immediately grows by an extra 5% from your employer. That's like doubling your investment without extra effort. Retirement accounts may also offer tax benefits, either reducing your taxable income now or allowing your investments to grow tax-free until retirement. Even if you can only start with 1-2% of your salary, contributing consistently and gradually increasing your contribution over time can have a significant impact. Small, regular steps often lead to meaningful growth in the long run. 4. Invest in tax-advantaged accounts. After employer plans, look at other tax-advantaged accounts such as IRAs or ISAs. These accounts can reduce taxes now or later, help your investments compound faster, keep your money growing longer without extra fees. Strategy: max out contributions if possible. Diversify investments within these accounts to balance risk and growth. Have you ever used a tax-advantaged account for investing? It's one of the easiest ways to get extra value without taking on more risk. 5. Build a diversified investment portfolio. Once you've built your foundation, your emergency fund is in place, high interest debt is cleared, and retirement accounts are funded, the next step is to focus on diversified investments. Diversification is a key principle in investing because it helps reduce risk while still allowing your money to grow over time. The idea is simple: don't put all your eggs in one basket. By spreading your money across different types of assets, stocks, bonds, and possibly other investments, you can protect yourself from large losses in any single area. If one investment falls in value, gains in another can help balance things out, smoothing your overall returns. Here's an example of a simple, balanced approach. 60% in broad stock index funds, stocks tend to provide long-term growth potential. By investing in index funds, you're not picking individual companies, but owning a slice of the broader market, which reduces risk compared to single stocks. 30% in bonds. Bonds are generally more stable and can provide regular income. They act as a buffer against stock market volatility, helping to preserve capital when markets dip. 10% in cash or alternative investments. Keeping some money in cash or alternatives gives flexibility. 6. Consider dollar cost averaging. Instead of investing a lump sum all at once, try dollar cost averaging. How it works. Invest a fixed amount regularly, quarterly. Buy more shares when prices are low, fewer when prices are high. Smooths out market volatility over time. Example, $500 per month into a stock index fund. Some months you buy at $50 per share, others at $55. Over time, your average cost may be lower than trying to time the market. DACA can reduce stress and prevent emotional investing. 7. Explore higher risk investments last. Once your basic investments are in place, you can consider higher risk opportunities like individual stocks, cryptocurrency, real estate, startups. Caution: only invest money you can afford to lose. Keep these investments as a smaller portion of your portfolio, often 5-15%. Research carefully. Before committing funds, higher risk investments can have high returns, but they also have high volatility. That's why they come last in the investment order. If you could invest $1,000 today, would you put it in safe funds or try a higher risk option? There's no right answer. It depends on your goals and timeline. 8. Monitor and rebalance your portfolio. Investing isn't set it and forget it. Check your portfolio periodically. Once or twice a year is enough for most people. Why rebalance? Asset values change over time. Your intended allocation may drift. Rebalancing keeps your risk in check. Example, you target 60% stocks and 40% bonds. After a strong year for stocks, allocation becomes 70% stocks and 30% bonds. Sell some stocks and buy bonds to return to your original allocation. This helps maintain your desired risk level and avoids overexposure to any single asset. 9. Keep learning and adjusting. Investing is a journey. Markets change, personal circumstances change, and strategies evolve. Tips: read books, watch educational videos, or follow reliable financial news. Stay patient and avoid emotional decisions. Adjust investments as your goals, age, or risk tolerance changes. Remember, the smartest investors aren't those who get lucky. They're consistent, disciplined, and patient. 10. Common mistakes to avoid. When it comes to investing, even small mistakes can have a big impact over time. Key takeaways. Start with a safety net. Emergency fund first. Pay off high-interest debt before investing heavily. Max out employer retirement plans for free money. Use tax-advantaged accounts to grow investments faster. Diversify your portfolio to balance growth and risk. Use dollar cost averaging to avoid timing mistakes. Higher risk investments come last, with caution. Rebalance and monitor periodically. Keep learning and adjust as life changes. If you found this helpful, give it a like. It really helps support the channel. Subscribe for more easy to understand investing strategies and tips. And check out the next video where we explain how to grow your money step by step, even if you're just starting out.